high moat, great business, Microsoft Office, name me a better office tool for everyday people. Guess what's going to happen?
Yeah, I think that's awesome. Maybe don't buy it now. Who knows?
We're going to go over Microsoft stock right now. We're going to go over a couple bull arguments, a couple bear arguments, and of course, we're going to use our stock analyzer tool to determine a value for Microsoft based on our assumptions about the future. So Microsoft is, when tech first became huge in the internet base, 20 some years ago, I remember somebody telling me the major tech companies of today and the ones that come will become the blue chips of tomorrow. They were right. Microsoft becoming a blue chip company. Cash cow, great balance sheet, company that everybody needs and wants and has to use. We use it every day. It's becoming a blue chip. So the question is, does that mean you pay whatever price for it? Mo, what do you think the answer to that question
Probably
is?
not.
Well, if you're new to the channel, that is the key here.
Yep.
We are value investors. We believe there's a price to pay for pretty much everything that generates some sort of cash flow. But just because you like a company does not mean you pay whatever price. And you might sit there and say, well, I don't believe that. Okay. I want you to stick along, stick with us, and run through Microsoft as a company. Let's go through some high-level things of Microsoft. So first thing I want to say, 2000, Microsoft hit a high of $58. It took them until, I think around 2015 or 16 until they broke that mark again. Maybe it might have been even 17 or so. It took 17 years almost to break that number again. Why? Overvaluation. In that time period, their revenue skyrocketed, their profits skyrocketed, but if you paid too much for a great story, it hurts you. Now, Microsoft's market cap, if you bought all the shares outstanding, $2.13 trillion. Their enterprise value, that factors in their debt and cash, $2.21. Very little debt. Mo, what do you think of that?
Yeah, I think that's awesome.
You look at their ROIC?
The ROIC is insane.
24.4% 5-year ROIC.
I love it.
What does that mean? Well, the return on invested capital is the return that the company gets on the money that's invested in the business through debt and equity. Okay? A higher return on invested capital means that the company can generate higher profits with less money. That leaves them more cash flow out there to do other things like pay down debt, buy back shares, pay dividends, and reinvest and make acquisitions, things like that. That's the benefit of a high return on invested capital. It's also some sort of indication of a moat. Now, does that mean that if Microsoft invested $1 trillion today, they would generate $1 trillion times 24.4% and $244 billion in profit in the business? No.
No, not likely.
You still need to be able to invest that money. But the good news is, as the world expands and they can't enter other markets, if they can continue this up, guess what's going to happen? They're going to generate much and much higher jumps and plateaus. So we like these things, high moat, great business, Microsoft Office, name me a better office tool for everyday people.
So it was funny. I was actually texting back and forth with Dalton today, and we were talking about a couple of the great businesses in the world, and that would be Apple, Microsoft, and Google. And he goes, I actually like Microsoft a lot more than Apple. With respect to Apple, you need to have their hardware to use their amazing software. These guys, there's not a hardware ecosystem.
Yeah.
Just use whatever.
Yep.
And I was like, well, damn.
Now,
great point.
I've said this story before, and I'll say it again. This is how stupid people are. 11 years ago, Microsoft was selling for 17, 18 bucks, and a tech guy said to me he would never own Microsoft. And I said, well, you not never. If you were able to buy it for $50 billion and had no debt and $100 billion in the bank, you'd buy it. And he said, no, I wouldn't. So that's the point when I talk about the emotion. This guy was immersed in the tech world and said, no, Microsoft's dead. It's dying. It's stupid. I wouldn't even buy it if I got $50 billion in profit and I could shut it down. He didn't understand that. He literally, I said, no. I mean, you buy $50 billion, you shut it down, you still collect $100 billion, you net $50 billion. He goes, yeah, even then I wouldn't buy it.
That's terrifying.
But that's the tech world.
Yeah.
That's the world in general, okay? So, Microsoft, let's take a look at its 8 pillars. Okay, this is what we love to see.
Yeah.
All check marks except for valuation. Now, guys, go ahead, Mo.
No, that's exactly what we like to see.
Now, remember,
And it doesn't mean maybe don't buy it now. Who knows?
with Microsoft, is this too expensive? Well, we have a high return on invested capital, and you should be willing to pay more money for this high return on invested capital. But the question becomes, how much more?
How much? Yep.
Right? I don't know. That's the art of investing. When it comes to, if you look at Apple, for example, Warren Buffett loves Apple, I think around $140 a share. It's got a 37% return on invested capital over the last 5 years. It's got a 50+%. But I think he's okay making 8 or 9% of his money in a high quality business.
Yeah.
Are you willing to do that? I don't know. I don't think I'm willing to do that because I have less money than Warren Buffett. I'm not 90. I'm not managing $250 billion of assets. You know what I mean? All these things that factor in, I've got to have a lower price for the company than Warren Buffett does.
Right.
Okay?
I think that's fair.
I think so too. So let's look at analyst estimates. Now, guys, remember, analyst estimates, take them with a grain of salt. We've seen the 2 weeks before Silicon Valley Bank collapsed, no analysts had them as a sell rating, okay? So they clearly didn't understand the books, et cetera. Now, they have them going from 955 this year in profit to 1628, almost doubling. That's pretty good growth right here, as you see.
Yes, for a $2 trillion company, yeah.
And look at the revenue, growing by low double digits a year, low to mid double digits a year for the next 4 or 5 years. Reasonable growth. This is good growth. And as the world becomes more technologically advanced, more and more modern, more and more first world, more and more people will need Microsoft. They're going to follow that trend.
Correct.
Right? And Microsoft's also has their own web servers like Amazon's AWS, cloud computing. They got very high margin in there.
They're working with Bing to do Chat GPT, and who knows where that kind of stuff goes.
And Bing is skyrocketing. Did I read today that Samsung is talking about making Bing their official
crazy?
What's it called? Web browser?
Yeah, isn't that crazy?
Yeah. Or not web browser, search tool.
Search tool, that's it.
I was like, geez, Pete.
It's crazy.
All right, so stock analyzer tool. Now remember, before we get into it, before we do a stock analyzer tool, we want to go over a few bull and bear arguments for Microsoft. Now remember, these are just some outlying high-level things, but they're things to consider about Microsoft, about any company going forward. But these are specific to Microsoft. And then once we're done with that, we're going to go into our stock analyzer tool and use that to come up with a price for Microsoft based on those assumptions for the future. So Mo, give me a couple of bull market arguments for Microsoft.
So first one, cloud intelligence has grown 17% year over year and 184% since 2017.
Okay.
Pretty big.
That's pretty big. What's another one?
So they just recently bought Nuance communication software for $19.7 billion. I mean, that's going to be huge going forward with everything that we're kind of talking to AI and whatnot.
Now, without looking into the direct
details of
it, I don't know what's involved in there. They probably overpaid. Just like I think the Activision deal is an overpayment. But again, they're going to be able to control. I mean, they have Xbox, so these things happen.
Yeah.
So, okay, what's another one?
So in the software and programming industry, Microsoft holds 40% of the market share.
Who's number two?
Oracle, 17%.
All right, so that's quite the lead.
Yeah.
That's quite the lead. Now, software, the great thing about software is it's expensive, but could also be cheap if you're doing it yourself. So there's a lot of people out there when they do open source things like that could, I mean, look at Google Drive. Google Drive is some sort of competition to Microsoft, but even with Google Drive's popularity, it has not overtaken Microsoft.
And for as long as they've been on the market, I mean, it's not even a blip on their radar, I wouldn't think.
We used to use Google Drive. Now we use OneDrive with Microsoft. Yeah. I like it so much more.
Yeah.
It's funny. I actually fought the conversion over to OneDrive. I actually love it way more now.
Yeah. Yeah.
It's the incredible part. Okay, what are some bear arguments for Microsoft?
So a cost to acquire a customer has increased 38%.
Okay.
But again, what is that? It's relative to what?
Yeah, and also, as a company is bigger and bigger and bigger and more saturated, to get the tail end, that's going to cost way more money.
Yeah.
And it's probably still a very profitable venture either way.
Yeah. And share buybacks. It's great, but what price are they buying it back at?
They are buying them expensive.
Average share of $276.
In the last year?
In the last year.
Okay, but again, if we can do an analysis and sit there and justify it, the problem is a lot of companies want to buy back shares just to boot the EPS. They have a lot of excess cash. They sit there, they don't have much debt. So people like hearing buyback of shares.
And this is another one of those companies that just consistently every year buys back shares.
I hate that.
I know.
I hate that. Did they not learn anything from Warren Buffett?
They pay a dividend as well, so.
All right, so let's go into the stock analyzer tool. Now, guys, if you like everything you've seen so far, there are so many more tools on the software. All of these listed here. There's this huge community of thousands of investors that you can talk to about all your investment ideas. It eliminates the concerns about what do you pay for a stock, what research to do. These guys have all done some research in here. You can joint research. This helps eliminate a lot of concerns about investing. So for $7 for 7 days, you can try out this software. The price is going up to $39 a month here shortly, and then $1 a month increase from there on out. So if you lock in, we still have people paying $12, $13 a month on our software. So by all means, go sign up now, because when it's $100 a month in a few years, you'll be really glad you did for $1 a day. Okay, so Mo, I'm gonna do 20-year analysis.
Okay.
You do 10.
Okay.
Guys, we'll be right back. All right, so we put our numbers in. Mo, tell me your revenue growth numbers for the 10-year analysis.
So I went with 5, 8, and 11.
Okay, for 20 years, I did 4, 7, and 10. Now, guys, 10% growth basically doubles the revenue 3 times over a 20-year period. That's an 8x growth. They did 300 some million last year. That'd be $2.4 trillion in 20 years. Mo did 11% a year over 10 years. Remember, in the last 10 years, they did 10.4. I probably would argue 10 years ago they couldn't do 10.4% a year. So I was wrong. Yeah. But the point is, put a wide range in here. 4 versus 10 is a very big difference, right? Yep. 4 doubles every 15, 16 years, 17 years, with rule of 72 divided by 4, 18 years. So it's barely doubling once. And here it's going up 8 times. Very wide range. Okay, profit margin.
29, 32, and 35.
I went lower. I did 25, 30, and 35.
Why?
Because I want to sit there and say, okay, let's say margins contract because overall market needs to.
Okay.
And let's say that they really are able to grow the software subscription and their cloud services. They go much higher. And 30, okay, I'm going to be a little conservative here. Have that little margin of safety.
Okay.
Free cash flow margin.
I did the same numbers, 29, 32, and 35.
This was harder for me because their free cash flow has been very consistent.
So I changed it to make it even, just because I was like,
Yeah, this one's hard for me. I put 25, 28, and 31. Okay. But I've been very conservative here so far, and I'll show that below. What'd you do for PE and price to free cash flow?
Both of them, I did 16, 17, and 18.
I did 15, 17, 19. And for my desired annual return, what'd you do, Mo?
10, 12, 14.
I did 9, 11 and a half, and 14. I think I'm starting to do all the big major players, the tech companies. I'm starting to do really conservative numbers here, but be okay with a lower return. Because I'm looking at going, would I buy Microsoft for a 9% return if this ended up happening? I'd be like, yeah, I'd be fine with that. So I hit the analyze button. The stock's currently at 286. Mo, and by the way, before we announce our stocks, I want you to know, after this, right after we do our initial values, stay on because I want to show you, these are factoring in our margin of safety. But I want to show you what we think intrinsic value is based on the company. So remember, our values here give us a margin of safety. So we're already putting a lower value to what we think it's worth. I want to show you what I believe the values actually are. So Mo, what values did you come up with that you would buy the company at?
So I have 131 to 141 on the low end, 190 to 215 on the high end, 158 to 175 in the middle.
Okay. I have 126 in the low, 200 to 220 on the high, and 160 to 170 in the middle. I have it on my watch list at 190. Now, guys, to get intrinsic value, I got to change my desired return to basically 10% because that's roughly what the market should do. And look at the values. Okay. Low side, 113. Middle, 190 to 200, high side 300 to 372. So this is what 330 to 370. So what this means here is if you believed our highest assumptions were true, you'd be getting a good deal here buying it today.
Yeah.
But the question is, do you think they're going to be 8x company in 20 years? Mo, what are your numbers?
So I'm about 141 on the low end, 289 on the high end, 200 in the middle.
Okay. So we're right around the same number in the middle range.
Yep.
All right, guys, thanks very much. Again, everythingmoney.com, $7 for 7 days. Check it out.